Good evening, everyone, and welcome to the CMS Infosystems Limited IPO Investor Roadshow, hosted by IFL Wealth. Thanks everyone for joining. I would like to thank the management team from CMS Infosystems as well for joining us this evening. We have from the team Mr. Rajiv Kaul, who is the Executive Vice Chairman and CEO of the company. We also have with us Mr. Anush Raghavan, who is the President at CMS Infosystems. Thank you so much for joining us today. With that, I hand over the call to you to take us through the upcoming IPO. Thank you so much.
Thank you, Abhishek. You want to put the presentation? We'll just switch on the presentation. Do we have access to to share a presentation?
Yes.
Okay, perfect. Right. Not the right one, yeah.
So we can see the presentation.
Yeah, we just started, yeah. Okay, and just click once and we should be able to move it. We don't click once on the screen, on the keyboard. Yeah. Oh, getting control there only. You want to move it here? We can just, yeah, I think we'll just move it here. Good evening, everyone. Thank you for your time on today evening. Our IPO started today and will run from 21st of December to 23rd of December. This is a complete offer for sale from our private equity shareholders who are our promoters. And the size of the IPO is 1,100 crores. We announced the anchor book last night. I think that detail is in the public knowledge. And from today, the HNI and retail subscriptions have started. So before I talk to the team, introduce the team and tell you about us, because the company is made by its constituent members. My name is Rajiv. I've been in the company for 12 years. I have a background in technology and private equity. I worked with Microsoft building their business in India as a CEO, moved to emerging markets, built a lot of their international emerging market business models and technologies. I then switched sectors into private equity in London with a firm called Actis Capital, and then came to India in 2008 to do my own buyout, partnered with Blackstone, and we bought a majority stake from the original promoters of the CMS family, the Grower family. Blackstone exited their stake in 2015, making a good return on their investment, and Baring Asia have been our partners since then. On my right is Anush. Anush has been in the company for 12 years again, joined us right after the buyout, has been in the company in a variety of roles. He's built businesses, fixed businesses, functions, ran an acquisition. We bought a company, he ran that company, and today runs our largest business, our cash management business. He also represents the cash industry as the president of Cash Logistics Association, which interfaces with IBA, the banks, and the regulator on day-to-day issues as well as long-term standards for the whole sector. The rest of the team has been there, our extended management team of 15 people. 7 of us have been together for more than 10 years. So it's a very strong, stable team, which has performed in both up cycles and down cycles. Our 15-year CAGR of revenue, a 10-year CAGR on both revenue and profits is around 15%. We also have doubled the management team in the last 2 years. So you see members like Sanjay Singh and Rohit, they have joined our team in the last 6 to 12 months as we ramp up on different service lines and as we start scaling up rapidly basis our current opportunities. At the board level, we've had a fairly high quality board at all times. We have Shamala Gopinath, who is a chairperson. She is a former deputy governor of RBI and also the former chairperson for HDFC Bank. We have Chris Chamras, who is a non-independent, non-executive director. He has been an independent director on the company for almost 4 years. He built Garda Cash, which was America's 3rd largest cash management company, which was sold to private equity. He is currently running 2 very large logistics companies in the US. Mr. Tapan Ray is an independent director on the board. He's a former secretary, Ministry of Corporate Affairs, and he is also the current CEO of the Gift City. From Bearing Asia, we have senior partners Jimmy Metani and his partner in India, Ashish Agarwal, on our board. So Big Four audited all through our tenure of 12 years is a very strong, well-performing team who's worked in strong ownership, high-quality ownership, and also a very strong board. We'll switch to what are we trying to become? We are a fairly unique platform. So I just will take you through a little bit of trying to explain what we do, because there isn't an immediate close peer which we could point you to understand us. But think of it as the whole BFSI sector. We feel there's a tremendous opportunity to become a large B2B outsourcing services company. We are in the process of building and creating this company, which is sort of solution or service agnostic. But our core principles of wanting to have high market share, of being a clear market number one, having very strong margin profile, very strong cash flow orientation and profit profile is something which defines what we do and what we don't do. In cash management, we are the clear number one in the country. This is a business which we have built over the last 10, 12 years. We have got very good market share in each of the sub-verticals out here. We dominate the sector in terms of our reach. We have a phenomenal distribution network in the country which covers every state. We have 238 branches. We cover 15,000 PIN codes. We do almost 60 to 75,000 activities around cash management every day. And we touch almost 1.3 lakh points on behalf of the banks and helping them provide access to currency and currency-oriented infrastructure like ATMs to their consumers in the last mile. We expanded in the last 6 years to build and manage services business. When you and I walk into an ATM, we don't put too much thought into it, but a lot of tech goes behind it. A lot of analytics goes behind it. And just creating that value chain and having an offering that is something we have built in-house over the last 6 years. We do everything from automation solutions, maintenance, and even the software, which you may see on many of the bank ATMs will be running, will be something which CMS is responsible for. Smallish business, growing very fast. We have just won in the last 12 months an order book worth 1,600 crores, which actually gives you a very good runway for future growth. Last year in 2020, we kept expanding and we started a new sector which we call tech solutions, broadly tech solutions. For right now, the area we focus on is helping BFSI clients, banks, insurance companies, gold loan companies and whatnot, help them remotely monitor their infrastructure, which is either their sites or their branches. Again, a very good win rate. We have 15,000 sites order book in less than 12 months of starting this business. And that order book roughly comes to about a 400 crore order book. So 3 different businesses. We go all the way from logistics to risk management to automation to software to tech SaaS businesses. That's why I said we are sort of solution agnostic. We want to continue working with BFSI. And as banks grow in the country in the coming 10 years, we want to be able to be a strong partner for them, helping them expand their network and reach, and also offer them both physical solutions, real brick and mortar, as well as digital solutions. Our business profile, last year revenue of 1,300 crores. We grew 21% in FY20. The year of COVID, our decline was only 6%. And I say only 6% because we are finally linked to the consumption cycle in India. Because banks' customers are consumers. As consumers do well in India over the coming decade, we should do well along with the banks. And therefore, to have a hit of only 6% was quite remarkable, which is a testimony to the resilience and the strength of the management team, our diversity of our business lines, and also the strength of our business models. Our EBITDA levels have consistently grown, 19% CAGR for the last 2 years. EBITDA margins have improved from 18.7 to 23.5%. And when you think of PAT levels, they've also expanded. With zero debt, 300 crores plus cash on the balance sheet end of March 21, and our CFO to EBITDA levels also very strong at 63-64%. So that's on the financials. To just summarize the way we think and the way at a simplistic level, what our strategy is all about saying there is a very large cash cycle, and Anush will take you through that. In the country, we are present uniquely in every element of the cash cycle at different levels of depth and penetration basis, how much work banks are outsourcing today. We think over the next 10, 20 years, banks will outsource more and more of the work in the cash cycle to good qualities, trustworthy, reliable companies like us. And I think we will be a big beneficiary of that outsourcing as it picks up. So we're still at a preliminary stage of outsourcing in most of the value chains. Some value chains are a little better evolved than the others. As we build our presence on each value chain, we are focused on scale. Scale gives us the network, we leverage our common shared costs, we increase our profitability, and we also create a very unique mode which most companies, including digital companies, aren't able to beat because they don't have the strength of the distribution platform. We take our strength and our cash flow in our established businesses and use that to expand and incubate adjacencies whenever we think the market opportunity is right, or those adjacencies are poised to grow, or there is a disruption in the competitive environment, and therefore we have a natural advantage. And then as a company which has been owned by marquee private equity client investors, we have a fairly good mix of, we have good experience in growing through both organic as well as inorganic way. So we've done a lot of M&A, mostly tuck-in, buying some technology, buying into a new service line, and then ramping it up. And we've also done transformation, consolidation, acquisitions in our history. So fairly rugged team with a very strong background and experience. So Anush, do you want to sort of dive in? And
thank you. So sort of the way we've set up our businesses and the way we seek to capture opportunity, in a way, sort of closely mirrors the way currency moves in the country. The cash cycle, as we call it, is really sort of starting with the moment the Reserve Bank prints money and issues that to the various commercial banks, and the money moves into the currency chest. Now, sort of the problems for us to solve here is really about how do we make sure that we provide a service which is reliable, which is relatively risk-free, and more importantly, ensures the lowest cost of operation to a bank. Because the cost of operation here isn't so much about the logistics cost, as it is about making sure that the cost of currency is as low as possible. The moment the money is in the currency chest, a bank doesn't pay an interest cost on that to the central bank. But the moment the money comes out of the chest, until we can get that into a bank branch or till we can get that into an ATM, there is sort of an interest clock which is sticking to the bank. And that is sort of where service quality and uptime become very critical benchmarks for our customer set. What we do is we help in both legs of this operation. The money, when it needs to go from being printed to issue to the broader public, can either go through a bank branch or it can go through an ATM, and we handle both of those legs. As on date, we handle more than 66,000 ATMs in the country on a base of about 150,000 which are outsourced, giving us a market share in the low 40%, 42, 43%. Beyond getting money into an ATM site, what we've also been able to do in the last 6 years is to capture and create as much as possible an integrated service and solution set around all the technology that goes into an ATM site. Right from helping the banks figure out what is the right location to set up an ATM, to selling them the automation product. It could be an ATM, it could be a cash recycler, it could be a self-service kiosk, for instance, to being able to sort of run the entire back-end tech stack. How do you keep the channel at a very high degree of uptime? How do you ensure that you do cash forecasting in the right manner? We do all of that in the ATM side. And then the newest business that we incubated in the last 1 year and scaled up to being a market leader just in the span of last 12 to 15 months around remote monitoring and remote technology. That is also sort of something that goes into an ATM site, which is linking into as many sensors and as possible to sort of create almost an IoT framework, which is remotely analyzed in the cloud and creates a trigger and alert-based system without the need for human intervention. So all of that sort of goes into the ATM side. Now, the moment the money is withdrawn from an ATM or a bank branch, and it's sort of consumed in the economy at large, we also work around the reverse logistics of picking up all this money from different retail outlets. We work with organized retail, we work with NBFC branches, gold loan companies, for instance. We work with e-commerce. The common refrain a few years back is, what happens to your business when everybody switches to e-commerce? Because then people are going to be buying digital and online. What we've come to realize is that sometimes life operates a little counterintuitively. More than 65% of all e-commerce purchases today are fulfilled through cash on delivery. More than 90% of all e-commerce purchases today beyond the tier 2, tier 3 locations are fulfilled through cash on delivery. So for an e-commerce player, having a robust and reliable partner who can provide this cash service becomes sort of an imperative for them to be able to scale the business. For us in the last 2 years, we've seen our business from e-commerce more than double. And from there, when we mop up the money from retail locations and bring it back to our CMS branch, We process it, we sort it, we have fairly advanced automated machinery which sort of does all of this, and we take the money back to a bank branch or to a currency chest. At which point also, there is a lot of outsourcing that is sort of underway, especially as banks seek to move away from operationally intensive and expensive work and automate and outsource greater parts of this value chain. So the currency chest automation, which is where we sort of bring in very advanced machinery to significantly reduce the amount of human work that's going into it today. We've done some very interesting projects with some of the largest banks in the country, but there's still a large part of this value chain that is yet to be outsourced. And from a perspective of participating in the greater share of that industry value chain, we sort of see a lot of potential out there. Should I take this?
Yeah.
Okay. So stepping, that's sort of really who we are, what we do as of today. But when you sort of shift gears and think about where do we see our growth coming in from, I think there are three clear drivers of growth as we see it. The first is from a perspective of the fact that the public sector banks in the country haven't really invested for growth in the last half a decade. Starting from demonetization and carrying on through the GST implementation, then being distracted with the NPA and the credit issues, to dealing with the public sector bank mergers, and finally COVID. In a way, sort of this has been a lost period for them. So they haven't really been able to either invest for growth, build their network, expand the reach as they should have done. Part of it also because a lot of them did not have the right capitalization and the strength of a book and equity to be able to do it. I think today they have come out of that and sort of have some bit of tailwind and momentum going. And when we sort of look at the last 18 months, we see that the public sector banks themselves have outsourced as many as 20,000 incremental ATMs in the last 15 to 18 months. Fundamentally, when you look at it, the story of ATM growth is one about keeping pace with the retail expansion and retail growth. If you take State Bank of India, for instance, State Bank of India by itself has 33% of issued debit cards in the country, but only 25% of the ATM network. Now, that fundamentally is not a ratio which is sustainable in the long run. At some point, you need to have a retail presence which befits the retail banking scale and size. And that is really sort of what is driving a lot of the public sector banks to ensure that they do a catch up with respect to all the lost period that they had and come out with RFPs to further enhance their retail network, which includes the ATM network. And in this period, when we've sort of participated in some of these orders, we've been able to win more than what used to be a historical share of this business and create a 2,000 crore order book on a business which is about 350 to 400 crore run rate revenue today. And so when you think of it as in, why would we have a right to win across public sector banks? And this is just one case study of how we've been able to execute. So you sort of take the largest bank in the country, which is State Bank of India. And what we're seeking to demonstrate here is the way we've been able to penetrate the bank and create a transformational win for ourselves year on year, starting from 2014, when we sort of made our entry strategy by getting into banking automation. So in 2014, what we sold to State Bank of India was an order for deploying more than 8,000 ATMs across the country, which even at that point and today continues to be the single largest order placed ever by a bank on any partner. And the successful deployment of that is sort of what helped build credibility for CMS and allowed us to move from selling banking automation to getting into more technology intensive work around software selling, for instance, and technology integration. So if you sort of take the 2018 project around multi-vendor software, now this is a program which we competed against only one other global OEM because there's hardly any people who have the skill set or the capability to do this. And what it entailed was, over the period of last decade, the State Bank of India has set up more than 60,000 ATMs, but they've sourced this from many different vendors, and it is a very fragmented tech ecosystem. They did not have the ability to manage this at scale through a single platform. So we went about building that software platform for them and running it through a CMS remote monitoring center, which helps manage all of this in a manner which is agnostic to what is the hardware and what is the tech stack that the ATM is running. And this is a long-term contract, right? So runs for at least 7 years with some extensions. And it's a contract which is also relatively future-proof, so that if tomorrow State Bank scales from 60,000 ATMs to 100,000 ATMs, all of that happens through the CMS platform. And that is sort of really what we've been able to do, which is take our take our expertise in the cash business and the relationships and the credibility we created there, use that to get into banks and start selling them on technology and get into contracts which are long-term oriented with greater recurring revenue to give us better visibility and better traction around some of the earning profiles of that. We've been able to follow that up with, in 2020, we won a order to deploy 3,000 ATMs for the bank, and also followed that through with being the largest partner for them on deploying the remote monitoring across their ATM sites. The aspiration for us is how do we sort of take this, which is what we've been able to do with the largest public sector bank, and replicate that with the next set of 4 or 5 large PSUs, which are sort of trying to also transition on a similar journey to what SBI has done over the last 4 years. Our second driver of growth comes in from what the RBI has been trying to do over the last 2 to 3 years, which is how do we upgrade and benchmark the quality of currency, cash operations or cash management in the country closer to global benchmarks. They undertook a study about 3 years back. There was a committee which was formed, which included the State Bank of India, the HDFC Bank, as well as CMS. And the findings and the outcome of that is what the RBI implemented across a series of circulars and notifications to ensure that all various aspects of the ATM and cash management ecosystem are upgraded and they come as close to global benchmarks as possible. The intent here being twofold, which is as a central bank, they were very concerned about the reputation of the Indian currency. Issues like Children's Bank of India not coming out of ATMs, the quality of currency not being what it should be, was one move which prompted them. The second being, how do we ensure the safety and security of the consumer who was getting prone to various sort of skimming and siphoning attacks at ATMs? So that really prompted them to push the banks to ensure that they do 2 things, which is upgrade the quality of the ATMs and the software to make sure that they are always contemporary and supported by the right security patches and software. And the second was ensure that they are outsourced to the right set of companies who deliver work across to a standard operating process, and also in a manner which lends itself to making sure that safety and security norms are taken care of. What this implies is the revenue pool for the industry will increase by 40 to 50% as and when this compliant norms are rolled out across the ATM and retail business points. As we speak today, more than 30% of the ATMs are already compliant, where the incremental price is being charged and paid by banks and customers, and 15% of the retail points are compliant. Our estimate is that in the next 12 to 15 months, majority of the ATMs should transition to compliance, and in the next 15 to 18 months, majority of the retail points should transition to compliance. At which point, the 40 to 50% increase will be rolled out to that set of the business points. When you think of this from a perspective of a 3 to 5 year window, it translates to as much as a 12 to 15% CAGR, which is pricing driven, but is what you will see in terms of revenue expansion to the industry. The third category being, which is what happens to the broader volume and what happens to the ATM ecosystem in India, because pricing is going up thanks to compliance and banks are outsourcing more work. Fundamentally, when you think of the ATM network in India today, we are the 3rd largest in the world. Not a fact which is well acknowledged by most people, but we are we only have China, US ahead of India. Despite which, right, we have 250,000 ATMs in the country. Despite which we lag the global average by more than half when it comes to penetration levels. Now, India as a country is significantly behind global averages on various different metrics, so nothing new there. But what is different is the fact that there is a significant skew to how these ATMs have been deployed over years across different geographies in the country. You have certain geographies like Delhi, Tamil Nadu, which are way ahead of the national average. They, for some reason, have been able to attract greater penetration of ATM deployment. But large geographic agglomerates, right? You can take Rajasthan, Uttar Pradesh, Chhattisgarh, Jharkhand, Orissa, for instance. These are significantly lagging the national average. They're just high single digits or very low double digits. Now, when India as a country will deliver and kick into a higher growth gear, it is sort of imperative that these large states will need to attract and get the requisite investments with respect to better entrenchment of financial channels and financial inclusion. And that formalization of the economy and greater financial inclusion in the economy is something that will lead to a greater usage of cash and possible digital also. When you look at the overall number of ATMs today, which are about 250,000, and you look at what has happened in the last 2 years or last 4 years, that ATM network has grown by a CAGR of about 4%. Now, 4% in an environment where we had a year and a half of COVID and further disruptions thanks to the bank mergers and so on. And our estimators, or the industry estimate, as per Frost and Sullivan, is that 4% will change to a 6%, not dramatically, just by 2% more over the next 6 years, which is we will go from 250,000 ATMs to 365,000 ATMs by FY27. What will happen within that is also the outsourced number of ATMs, which are today only 60% of 250,000, will increase by 275% in this period. So as a result of which, the total number of outsourced ATMs in the country will go from 150,000 to 250,000 over the next 6 years. So that lends itself to a volume growth of 10%. And then when you think about the ATM revenue pool, you have a 10% volume growth and potentially a 12 to 15% pricing growth that happens in the next 3 years, which lends itself to at least a 20 to 25% revenue growth over the 3 years to 5 years, 5-year window. And similarly, when you think about it from retail, today we only have 110,000 retail touchpoints, which are outsourced for cash management by banks. Retail in the country will grow. Organized retail will grow as we speak. Almost every large customer of ours is working out on a plan to extend themselves and get better entrenched in tier 3, tier 4, and tier 5. The idea being that retail is a long-term story in the country, which will expand over a 10, 15, 20 years. It's not an immediate transformation, but it will grow at a 12 to 15% CAGR year on year. So similarly, a 12 to 15% volume growth in retail, compounded with a price increase thanks to compliance, should also lend itself to a 20% expansion of the retail spends in that business.
So just to come back and summarize this whole thing for you, we are at a fairly interesting juncture in our industry set, which is the banks. The banks having come out of their NPA issues, they're dealing with GST-related issues, and also finally the PSU bank mergers. I think throws up a fairly interesting opportunity where the banks are looking at an upswing post-COVID. I think they're furiously investing for the next 10 years in growing their businesses. They're better capitalized than they were before. There also has been a logjam of the fact that in the last 2-3 years, most of them did not have adequate capital to invest in their infrastructure. The infrastructure could be branches, it could be ATMs, it could be technology, it could be whatever it be. And now they need to catch up. They need to compete stronger. And they are doing that now. So we've seen a fairly large pipeline already at play. 3 to 4 to 5 years ago, we weren't even bidding for these contracts at an integrated level or as a managed service provider. We either didn't have the capabilities or we weren't eligible or we hadn't built enough proof points to the banks for them to feel comfortable that we had the technical skills and the quality to do it. Today we are, because when you think of the fact that we have won large 1,000 crore plus contracts with banks like SBI, it tells you that we have established not only our service offerings, but quality and scale and confidence and reputation. So we are in a cycle where we are ready with the solution sets, with the delivery mechanisms, and there is a very healthy pipeline of contracts up for bids. Think of it again, I go back to IT because I come from the sector. Think of it as a high quality IT services company, no debt, strong cash flow generation, good EBITDA percentage margins, and they're bidding for large contracts. Every X number of years, there is a contract refresh cycle for key clients, right? The big ones internationally for us is the public sector banks in India. What that does is, and also the fact that the complexity of managing the ATM channel, both from the logistics and risk management, the technology part is becoming quite difficult for banks. It has become a specialty set, and specialist firms who have built that capability will offer a much better quality, uptime, cost, benefit to the banks. So for us, the market size, when you think of just our cash management business, which is what we did in FY14, is today that's a 2,800 crore business, which is poised to grow to 8,000 basis of triggers Anush entailed to you, which is almost a 20% CAGR opportunity for the market to grow for the next 6 years. When I look at the managed services sector and ATM plus the remote monitoring business, which is part of it, that's roughly a 7,000 crore business in FY21, almost $1 billion market, poised to grow to 17,000 crores. You add these two, and sorry, just in cash management, we are a clear leader, growing, gaining share every day, every week, every month. As we consolidate, and the sector is already consolidated because it renders itself to only scale players, not more than 1 or 2 companies can really make it work in the sector. We should get a disproportionate share of the revenue in that market as it grows from 3,000 to 4,000 to 5,000 to 6,000. So that's your base case. Our base case is that we will have a higher share of the cash management market in India because we are a clear established market leader by a mile. But you got to manage services. That's where we are an emerging leader. We're very focused on businesses and high quality contracts. These contracts are recurring in nature, where the bank will sign you up for 3, 5, 7, 8 years. So you get very good visibility, you get very good predictability, and as you have longer term contracts, you invest, you automate, you drive efficiency to improve your margin profile over that entire period. So good mix of annuity and recurring business. So therefore, from a trajectory of growth is more stable and smooth rather than big spikes up and down. The second thing is that large market and managed services, even though we don't want to get all of it, but we have a very strong play and a very strong right to win established by the proof points of the order book we have won in the last 12 months, which should give you confidence that we should execute stronger as other banks come with those offerings to market and look for strong companies to partner with. So I think the combined set of the TAM, and if you remove some duplication, is almost an 8,000, 8,500 crore market, in which last year we are 1,300 crores, growing to a 21,000 crore market by FY27. We have missed a slide here. If you look at the FY22 current year numbers, our current year numbers for the 5 months, which is updated in the DRHP, is almost the revenue is about 625, 650 crores, and the PAT is about 84 crores. Is it here? I don't think they have this here. No, they don't have. This is the older deck, I think. So if you extrapolate that 5 into 12, just a straight line without any straight line, we would be a 1,500 crore revenue and a 202, 203 crore PAT, which roughly would mean that we're growing revenue 15% over last year and PAT 20% over last year. Now, and margins have expanded. Our margins as of August had expanded to 24.1% EBITDA margin. Now, the first 5 months of the year also had 3.5 months of very intense COVID wave 2. So there was some impact of that, and therefore, while I can't give you any forward guidance of what will happen in the rest of the year, but you can make your own assumptions on what type of growth you would underwrite for FY22, and then hopefully FY23. You should look at the fact that we have this 2,000 crore order book. Assuming we were able to finish the execution of all that work in this year somehow, that order book itself should give you additional incremental revenue of 200 to 300 crores range for the next year, which gives you a base of growth for next year. As you grow revenue at that clip rate of 18-20% a year, you start getting a lot more flow through to your EBITDA and PAT profile of the company. Let me see. So I think on the new growth sides, we have a lot going on, but the one I want to talk a little bit more about is sorry, you want to click that one, the remote monitoring business. The remote monitoring business, Anush talked about it. We are basically helping our currently a BFSI clients remotely monitor the health, security, safety of their infrastructure. This is moving from physical to digital. In the digital space, is a tech SaaS solution where it is high-end sensors, which will manage everything from the energy levels used, when is the site up and live, managing high-quality cameras where you will where the software will check for intruders, any safety issues out there, everything done remotely, everything done on the cloud software. There will be some people at the back end, but our software work and our automation and self-learning technology, which is another word for AI, is fairly good. I think it's today the best in class. It helps us cut down significantly in operating costs and also prevent incidents in the proof points we have delivered already to our banks, and we've shown that to them. We have won big contracts, almost a 10,000 site contract for SBI. Another public sector bank has awarded us a contract for 5,000 sites. There is a massive amount of ATM sites which still need to move from physical to digital security. And I think we are clearly, in a period of just 1 year, having a fantastic run rate, which should hopefully establish us as the clear number one, like we established in the cash management business over the coming year. So that's also, again, I said we have a 400 crore order book. You take the order book over a 5-year period, you can see that revenue going from 0 to an 80 crore annual run rate in a short span of time. But the broader opportunity here really is that fact that there are many sites where you can have much better technology. Old days, you would have a camera, one DVR recording. It really doesn't do much. There is no software element to it. It's sort of a dumb terminal, record something happens, then you go and check the DVR, assuming the DVR is still there and hasn't been broken or stolen away. But everything is on the cloud. This can work across sectors. There is no reason our technology cannot be customized for any other sector. But however, the caveat is that we've just started this business. We are focused on BFSI because we think that's a big sector. But I think the broader opportunity here is almost a 10,000 crore market opportunity in the next 5, 7, 8 years. And depending on how fast we can scale, this could become an entirely big vertical with very strong margin profile because of tech business and also hopefully a totally separate company, which would be targeting broader than the BFI sector. That's optionality which this will present to us as a team and to our shareholders. We just go back. If you look at some of the other areas of evaluation, and I want to be careful, we're looking at micro ATM networks, we're looking at collection and Uberization of cash pickups in the country. Can we be a corporate VC partner at scale for banks and help make money while doing it? What value can we bring at a Kirana store or a merchant payment outlet, which they're not currently seeing? Is there a way to manage the entire digital, physical element of an infrastructure of a smaller retail store and be able to make a profit while doing it? And finally, how do you use an ATM channel, make it more multi-use? How do you go from just it being a cash withdrawal mechanism to maybe a cash deposit, which the banks are working on, and then also to do things like bill payments or whatnot, so that people just use ATMs as a way to transact far more than what they're doing today, because that's the power of the technology there. It's not been fully utilized by many banks. And given that we are one of the unique players who does ATM deployment to ATM software, I think we are well placed to be able to conceive, create, and then launch these solutions and see how the market responds to them. So I think that brings us to the end of our session. So I think we can kill the presentation, look at the questions. So I think just to summarize, I think we are a fairly interesting team, very, very rugged, very resilient, have proven ourselves despite demonetization, despite COVID. We have built a very good quality business, strong return metrics, which we are looking to, and the cash flow generation is strong, which we are looking to invest into other new high growth industries or sectors. Our goal remains the same. We look at a sector only if we think we can be a clear number one, get the economies of scale, have a very strong margin profile, offer very good pricing to customers so they benefit, and keep increasing the moat using both technology and physical distribution vis-a-vis any other competitor in the landscape. Thank you so much. We'll take questions. So Abhishek, I don't know, do you want to moderate or should we just read the questions and start answering them? How do you want to do this?
I can ask the questions, and
okay.
That will work. So thank you so much, Mr. Kaul. Thank you so much, Mr. Raghavan, for the detailed explanation. I would like to inform all participants that they can post their questions in the Q&A box. So we'll start with the first question. The question is, how do we plan to diversify our revenue model, considering that the economy is gradually shifting towards cashless transactions? Any numbers on the revenue split that we target going forward would be helpful.
Sure. So, we really can't give you guidance of the future and how we are even thinking. And we also don't know how this will pan out. But let me explain this to you in a way that you can start making the assumptions. As of last year, FY21, we had 900 crores of revenue from the cash management business, and we had 365 crores of revenue from the managed services business. And the other business was about 45 crores. So that totals up to 1,300 crores. The managed services business has an order book of 1,500 crores, which has been won today. That order book is under execution. Some of it is already resulting in revenue. Some of it will come into the next financial year. But that order book of 1,500 crores, and take it on an average of, let's say, 7 years, right? It's a 250 crore revenue per year, which would get added to the 365 crores, hopefully, if we do a good job of execution. Then in addition, we have a new business on remote monitoring, which is zero revenue last year, zero. We have won the orders this year. We are getting deployed. They will not get finished this year. But whenever we finish the 15,000 order book we have and whatever else we win, you will have an annual revenue run rate. Let's take an easy example, 400 crores by 5, 80 crores or so per year. So these are now two new businesses, two new or recently new businesses growing very rapidly on a smaller base. Coming to the cash management business, that's a business which, we, as even as per the Frost and Sullivan study, the market is poised, has the opportunity to grow at a 20% CAGR for the next 5 to 6 years. Again, a significant part of the growth is from the pricing change, which is already enacted between the various industry constituents and the regulator. The second is linked to the fact that penetration is still very low of ATMs in many states. Retail is a 10 to 20-year opportunity because I don't think India will move, that's my personal view, will move to organized retail lock, stock, barrel or move to e-commerce lock, stock, barrel. I think vast majority of the country is still served by a small store. And that transition will be linked to how the per capita GDP income of the country will evolve and move up significantly. Assuming it goes on a steady clip rate, I think we are talking about a 10 to 15 to 20-year perspective where the retail cash management will become a very large part of revenues in that period of time, and also secures your thing. Because many people think about terminal value, then they think of cash and where cash is going. And I say, if you look at the public data, there is 30 lakh crores of cash growing at 12% a year for the last 6 years. Cash isn't going anywhere, whether we like it or not. That is the reality of majority of India. Is digital growing? Absolutely. But the important point, which I go to pains to explain, is that we operate in the formalized part of the economy. The informal economy, not the black economy, the informal economy is massive in the country. And that will change steadily to formal economy basis government initiatives, basis just economy improving and people improving and how they consume. And when that happens, we get a direct beneficiary. We are a B2B company, but we are linked to the health of the economy. We're linked to the economic growth. We're linked to the consumers' income growth. So I think last year our revenue split was maybe 68-32, 68% revenue from cash management, 32 non. And I think that share will go down simply because the other smaller businesses are growing rapidly. But the cash business also will be growing very well in our estimate for the next 5 to 6 years. So therefore, would you see this changing to a 50-50 overnight? I doubt it. I don't think that's going to happen. But who knows? Depends on what M&A opportunities come. Depends also on the remote monitoring sector, because that's a new sector, right? Our experience of that is less than 12 months old. It is a great experience. And while we are very bullish about the business, we'll have to see how much and how quickly are we able to launch our offerings in other verticals, and how quickly can we ramp it up in BFSI and then beyond BFSI.
Thank you so much, Mr. Kaul. I think we can segue then into the next question, which talks about the cash on the balance sheet and how do you plan to deploy this cash going forward to improve ROEs? And I think you spoke about briefly, are you looking at any areas for inorganic growth?
Yeah, so, inorganically, I talked about the fact that we've done 7 to 8 transactions in the last 8 years. We have experience of doing small deals to large deals. We are fairly value buyers in terms of our capital allocation. That's why we have cash on the balance sheet. That's why we run a business of this quality. We are not a company, and I want to share that we are not a company which will grow at any cost. We are very focused on balancing market share, margin, revenue growth. We have done it for the last 10, 12 years. That's what we are good at. That's what we'll hope to do in the coming 10 to 12 years. Coming to cash on the balance sheet, I think we are in the middle of a fairly intense capital deployment cycle. Over the last 3 to 3.5 years, we have invested about 300 crores of capital. A significant part of that being invested today. Part of it is to achieve compliance with new RBI standards for market leader companies. Part of it is to deploy capital for some of the contracts we won for the public sector banks. And I think we are, and therefore as shareholders, as hopefully new shareholders, you get a benefit of the deployment, the order wins, resulting in good revenue growth, profit growth in the coming years. So I think from an inorganic perspective, we will look at acquisitions as usual. We will always look at acquisitions. We always do. In the new areas we told you about, we look at acquisitions. But usually if we get into a new sector, we start with a small acquisition, right? We'll do a 5 crore, 10 crore, 15 crore deal to just, once you're convinced, and then we ramp it up. But there is consolidation opportunity in remote management, where we could use that to scale much rapidly and get efficiencies of scale. We could also look at consolidation on cash management business, which is a sector where globally, if you go to America, there'll be like 2 or 3 companies in the entire United States working now. You go to Brazil, you go to Argentina, you go to Europe, it's usually a 1-player, 2-player market. And actually the player number 1, it makes majority of the profit pool. So we've done many consolidation opportunities there, both tuck-in and bolt-on and transformational. as and when they are available at a price and value which we think is synergistic to our business, we would like to indulge in trying to acquire those companies and businesses. So I think that's what we think of right now. Of course, things change. The one reason to also go public is also to create opportunity and currency for growth, assuming it comes from the non-core sectors, and who knows what comes in. Once you're listed, there could be different opportunities and challenges. But for our core businesses, I think we're well capitalized. We have enough cash or balance sheet strength to be able to do this in the foreseeable future.
Thank you so much. Moving to the next question, I think towards the end, we spoke at depth about the remote monitoring business and the future growth drivers. So I think this one's along those lines. Can you give us some more details on what the IT services business does and any numbers on its contribution to total revenue?
Yeah, so just forgive us a little bit. We're not very good at branding these services right now. It's not IT services. What I was trying to allude to the fact that as we have built an IT services quality company with 24% EBITDA margins, with very strong PAT and whatnot, but focus on the Indian domestic market and Indian B2B outsourcing services companies. You don't find usually companies of our revenue size, margin profile, EBITDA profile, cash flow. I don't know of any companies there. Coming to the question of the technology solutions business, which is, we do few things in technology solutions. We're doing software for ATMs, right? Multi-vendor software for security. We have made our own software called CMS Algo, which some banks have started, 5 banks already using that. So there is some work we're doing, which is niche, but it's very interesting. It's high quality of software. Opens up different opportunities as and when they present us to ourselves. The second is the big one, which is the remote monitoring. The remote monitoring is an area where banks are trying to improve both the quality as well cut down the cost of physical guarding, because it doesn't render itself to what they want to do. And banks have an imperative from RBI to move to remote monitoring solutions at ATM sites. And as of now, out of 255,000 ATMs, our estimate is only 95,000 have moved to that solution set. And some of them did it 4 or 5 years ago, and the technology is maybe obsolete now, and the standards now are better or higher. So we think that's a very interesting opportunity. That's what we are immediately focused on. Our sales teams understand the client. We know the opportunity. We are sizing, mining it. We made a small acquisition in last year, which just culminated to be able to launch that service offering out of the box. And now we are working with our own engineering teams to improve that software and the sensor technology so that we can make it really fantastic quality and save on both capital costs and operating costs. So that's a business where I said right now we have an order book of 400 crores. That sector is today an 800 crore sector per year. We would, if the 400 crores results in 80 crore revenue per year, assume we have a 10% market share in the first year of operation. We intend to take the market share up to good levels, but we also intend to expand that to bank branches, gold loan branches, then go into other sectors, warehouses, logistics, manufacturing, whatnot. But these things take time. Creating the technology and getting the software to learn and improve and launch this there is always a timeline and timeline. But that's why I say in the next 4 to 5 years, that could become a significantly large business for us. That's why we are investing the time and effort into it right now.
Thank you so much. Moving to the next question. Any particular reason for the issue being completely an OFS?
Sure. I mean, first and foremost, an OFS has got no implication on the company's growth potential and growth profile. I think like any well-capitalized company which is owned by private equity, they look at monetizing the stake over a period of time. Blackstone bought the company in early 2009, sold the company in 2015, at which time also the founding shareholder family also exited at that time. Bering Asia bought the company 100% at that time. So Bering Asia will have another 4-6 years to dilute their stake. They are coming up with an offer for sale. This will lead to a 35% dilution. They, as promoters, will still have a majority stake of close to 60-65% in the company. And also, I think it's very important for us in the current landscape where we are looking to grow the pipeline we have. We are ready for being a public company. We've had a fantastic golden governance. We have very good visibility on the order book and the revenue trajectory we can have so that our public shareholders can feel solid about this company as we launch into being going from a private to a public listed company. And finally, I think it's also about creating the right incentive to attract talent into the company or retain talent in the company when you are competing with a wide variety of companies across sectors today. And the last one is, I think it also hopefully presents us with an opportunity for using non-cash capital at the right time, at the right stage for expanding beyond our current set of offerings.
Thank you so much, Mr. Kaul. I think that closes the question queue that we have so far. Any of the attendees would like to ask any questions, please post them in the chat box now. Barring that, sir, I would hand over to you for any final closing remarks.
I mean, I think, I've said it in the opening and closing again, right? At the risk of repeating myself again, third time, I would say, if you decide to invest in CMS, what you should expect is a very committed, hardworking team, which is usually at the front of any crisis in India. Making currency available anytime, any place on behalf of RBI and banks is something we pride ourselves in. We have 23,000 team members who do this every day, take the risk of doing this every day in good times and bad times, and make sure the economy can run, commerce can run. As a team, we are very focused on the BFSI sector, building a high market share, market leader, high margin, strong cash flow generative business. We have grown, whether you look at from a 3-year perspective, 5-year perspective, 10-year perspective, we have consistently grown. Our aim is to become public with a goal to become a consistent compounder, as people call it, over the next decade, create a solid institution, and take this company to far beyond its current potential.
Thank you so much, sir. Thank you, the management team from CMS, and thank you, all participants of this call. We really appreciate the time. I think we can go ahead and close this call. Thank you so much.
Thank you. Thank you so much. Good evening.